go, here we go, yeah. At the top of the class on a roll, hey. And it's time to run it up, yeah, you know, yeah. Mask down, put the pedal to the floor, yeah. On a roll, here we go, here we go.
What is going on, everybody? Welcome back to the channel. And in today's video, I want to talk about something that I haven't really touched on in detail, and that is fair value gaps. Now, you guys might have heard me talk about fair value gaps very, very briefly on my live stream, but I've never actually gone ahead and dove deep and explained what they are. So in today's video, I'm going to talk about what a fair value gap is, how to spot them on the chart. We're going to take a look at how price interacts with these gaps and how you can use these to your advantage when you're trading. And then at the end of the video, guys, I'm going to show you how you can use an indicator to spot these fair value gaps without actually having to dig into the charts and figure out exactly where these gaps are happening. But before we get into it, guys, make sure you hit that subscribe button, smash the like, and click that notification bell so you don't miss any of these great tutorials or urgent market updates that we upload to the channel. Now, what is a fair value gap? You may have heard people on YouTube, either myself or other YouTubers, or maybe you just hear other traders saying, hey, we have a gap up here at this price. We're bound to make our way back up there to fill the gap. That's probably the terminology that you hear a lot is, oh, we have to go down and fill that gap. And you're probably thinking to yourself, if no one has ever told you this, like, what are these gaps? What do they mean? And why do we have to go fill the gap? So I'm going to try to easily break this stuff down so you guys can understand how to spot these gaps, what they are, and how you can use them in your trading. So first off, let's talk about what is a fair value gap. Now, fair value gaps are created typically when you get a big explosive move to the upside or a big move to the downside. These typically pop up in rapid moves in either direction, and basically what they represent is an imbalance in price. So when you get a very explosive move to the upside, you may create what we call a fair value gap, showing that there is almost no selling pressure whatsoever and only buying pressure. You will create that gap, and the reason this is so helpful when trading is because when you create these gaps, the market has to come back down to revisit these areas to bring balance back into the market. So the wheels are probably spinning in your head and you're like, okay, so if we create a gap and price keeps going, you could expect that price will come back down and fill that gap. And that is exactly what I'm saying. Now, it doesn't mean you're immediately going to come down and close that gap. Sometimes it takes days, weeks, months to come fill those gaps, but chances are that price will come back to revisit that level at some point to rebalance the market. Let me go ahead and bring up this graphic to further explain what fair value gaps are, and not only that, but how you can actually spot them in the market by looking at the chart. So you can see here, fair value gaps, also known as imbalances, as we were just talking about. I'll just read through this stuff real quick. So a fair value gap is a gap of liquidity left during the move down in price due to no buying pressure overlapping that part of the move in the previous or next candle. So basically what you're looking for here, guys, is as you can see, this little orange highlighted area would be your fair value gap. And you can see we have a wick on the right side of this big candle here, and your wick stops there. And then on the other side of your big impulsive candle, you have another wick, but there is a gap between these wicks where there was only selling pressure. So this is what's called a fair value gap. And then you see the key point in identifying these fair value gaps is that the gap is only calculated by the impulse up or down candle, which would be this candle right here, and the candles on either side of that move, being this candle and this candle. Everything else does not contribute towards the gap. So what you're looking for is a big impulsive candle, and then you're looking to the right and the left of that candle, and you're looking at the wicks, the space in between those wicks where all that is left is a big body of selling or buying pressure is your fair value gap. These pockets of liquidity are important and can act as strong entries as the market is drawn to liquidity, meaning that when price is planning to move down, it wants to clear the liquidity above beforehand, in turn making the liquidity pockets themselves a great entry before the move down. and vice versa with moving up. So you can see on this side of the diagram here, you have a big impulsive candle right here. This is obviously in the opposite direction. This would be on the buyer side. You have a big impulsive candle, so you know you're looking to the left and the right, and you see you have a wick here, and then on the right side, you have a wick here, leaving nothing but a big gap of buying pressure, and then that would be your fair value gap. So this is essentially how you spot these on the chart. So without further ado, let's go ahead and pull up TradingView so I can show you guys how you can actually spot these and what they actually look like on the charts, so you guys can easily look at a chart and spot these. And then again, like I said, stick around till the end of the video because I'm going to show you how to use an indicator that can point these gaps out for you so you don't have to hunt and look for the gaps and look for those wicks and the space in between and all that nonsense. You could just have these gaps highlighted by an indicator, which is super, super helpful. Now that you know a little bit about what a fair value gap is and how to identify them using the candlesticks, let's talk about how price action interacts with these fair value gaps. So now that you guys have an idea of what a fair value gap is and how to look at the candles and identify where these gaps are, let's go ahead and take a look at a couple of examples on the actual charts. So here we are on the Bitcoin 4-hour chart, and let's go ahead and see if we can identify any fair value gaps here on the chart. So already I'm looking here and see we have an impulsive selling candle here. I'm going to go ahead and grab my brush tool here. You can see we have our impulsive candle right here in purple. It is a selling candle. Now we know that this is the big move, right? That's what we're looking for. An impulsive candle is just another word for a big candle, right? An explosive move in either direction. We see we did get a big move to the downside, so that's our impulsive candle. Now we're looking to the right and the left at the candles beside it, and we're looking at specifically the wicks, and I'm going to draw a horizontal line right here because this wick came right down to that horizontal line. And then I'm going to go ahead and grab another horizontal line, and I'm going to go ahead and put it right on the wick to the right of this candle. So we have a wick on the right, a wick on the left, and our impulsive candle in the middle, creating a fair value gap. So this would be your fair value gap, and we get that fair value gap, and I want you to notice something. As soon as we get that fair value gap, what did price do? Right after it dumped to the downside, we got a bounce, and price came right in to retest that gap, rebalancing the market, right? So you have impulsive candle, strong selling pressure. You create that gap, and then you know that it is likely that you're going to come up and fill that gap. This is what people are saying when they say fill that gap. I'm sure there is a ton of you out there that hear other traders saying, oh, we have to go fill this gap at this price, or we have to go down here and fill that gap at this price. And you're probably like, what do they mean? This is what they mean. The reason fair value gaps are actually very helpful when trading is because we know that when you create a fair value gap, the market likes to revisit that level to rebalance the price, right? Or rebalance the market. And you can see we actually came in and grabbed some liquidity here at this point and at this point. And then even if you want to stretch it out, we almost came back up to it right here. So that was a quick example of a fair value gap on the seller side, but now let's go ahead and look at the fair value gaps on the buying side. So if we just scroll down a little bit here in time, you can see we have a big green candle here, or blue in my case, but we have this big explosive candle here showing that there was very, very strong momentum to the upside. And in between these two wicks, I'm going to put another horizontal line right here because I'm looking to the right of this candle. We have the wick there, and then you look to the left of the impulsive candle, you have the wick right there. And what does that do? It gives you your fair value gap, just like that. And then price actually came down and almost touched that gap and filled it right here, but we continued to the upside. And then eventually, as we move away from this fair value gap, as it still exists down here, we are expecting at some point to come back down and fill the gap, right? And rebalance the price. So we come up, and then boom, we wind up coming down and filling the gap right here, as you can see. And now you can go to the charts, guys, and back test this and actually look at how price interacts with these gaps. Does it actually go up and fill these gaps, or not really? I mean, the answer is they do, right? So I definitely recommend you guys go back test this on the charts and just find your gaps. And after a few minutes of looking for these, you'll be able to spot them immediately. They pop up all over the place. And I do just want to say, I have heard other people on YouTube explain this as like when you're drawing with a crayon, if you were to drag that crayon across the paper very quickly, you'll actually get gaps. And I thought that was a really clever way to explain this because these fair value gaps pop up in explosive moves to the downside. So when you have a big, quick, aggressive move to the downside, you can think of it as dragging a crayon down a piece of paper very quickly, giving you those little gaps in color that you would see on a crayon. If you went to kindergarten, you'll know what I'm talking about. So now that you know a little bit about what a fair value gap is, how to identify them on the chart, and how price interacts with them, let me go ahead and show you guys an indicator that you can use to immediately point out these gaps so you don't actually have to go and find the wicks on either side of the impulsive candle and find the gap and draw the lines and make a box and all that garbage. You can actually use one of my favorite indicators, Lux Algo Premium, to find these fair value gaps. You guys know I made a video about this last week. This is Lux Algo's new price action concepts indicator. I have really been liking this indicator, and I want you guys to realize something, and that is these red and green boxes. So I just went ahead and turned everything off this indicator except for the fair value gaps. So we're actually going to go back and use our bar replay mode, and we're actually going to take a look at this chunk of price action right here. Now, as you can see, we have a bunch of fair value gaps down here. And I do just actually want to talk about the fair value gap that is about to form as we move the time forward here. So we have a bunch of fair value gaps down here, and then you can see this mega candle down wanted to go fill these gaps, and as price moves along, you can see that we actually came down and filled all of these gaps. You can see we wicked down into this one as well, but on the way down, guys, we also, there you go, we actually just filled this one as well. But as you can see, we're actually creating gaps now on the selling side. So as you got this explosive move to the downside, you could see Lux Algo Premium actually picked up on this, and it marked the gap out for you. And if we zoom in, you could see it's finding the same thing we were just looking for. It has the impulsive candle, and then it looks to the wick on the right and the wick on the left, and then draws your gap in between those wicks like we just did manually. So you can totally do this for free, guys. I am not just doing this to show off this indicator. You can do it for free like we just did. But for those of you who want to spend a little extra money to save the time and make your lives 10 times easier, I highly recommend this indicator. I use it all the time. But the point here is you could see you got that explosive move to the upside, creating these gaps. Then price came down, filled these gaps. And now we're creating these gaps to the upside. And the question is, or the thing that would be running through your head at this point is, okay, well, at some point we have to come up and fill these gaps. So price moves along, it moves along, we kind of just range, right? And we started to move even lower. So now we're watching, this is what I mean as, you know, sometimes like you just saw right there, sometimes these gaps can get filled immediately, sometimes they get filled in the next 5 minutes, and then sometimes it takes weeks or days or months or a long time to go fill these gaps. And you can see here, these gaps actually got filled much quicker than these did. So you can see, then you got a wick right up to fill that gap. And there you go, we wound up getting that one as well. And then we wound up getting that one as well. But as we continue on here, let's see if price is actually going to come up and fill these gaps up here. And you can see as price runs here, you're always creating gaps to the up and downside and constantly filling them. And boom, there you go. You can see we actually just filled that gap right here as price came up. And if we go ahead and draw a line from these tops, you can see price actually even came in to test this gap, but we didn't wick far enough into it to make it disappear. But you can see price did actually revisit and take out that first gap we had right here, and we are even starting to dip into this one. And you can see now you have a bunch of fair value gaps to the downside, so we would expect price to come down and eat all these gaps up or fill the gap. And you can see here, if we play price forward, eventually, as we create more and more green gaps, boom, there you go. Price came down and took out all those fair value gaps. And if you go ahead and backtest this, especially with the indicator, it's very nice to see You know, typically when you see a lot of green gaps like you do right here, this is just, there's tons of gaps down here. The market is very imbalanced, and it is likely that we come down and fill these. And then you can see it actually happens extremely violently with that mega drop to the downside right about there, right? You just get all that massive drop down, but you would have already basically been expecting that, right? Because you had all those gaps and you were expecting price to come down and fill them. But you can see, you know, these didn't get filled, so they don't always get filled right away, right? These might not get filled until weeks or months later. But this is just another thing you can look at, especially you can use it on any time frame, and it just gives you a better idea, right? So if you are looking at maybe your volume, your VPVR, something like this, and you see that there's a massive volume gap and you have a bunch of fair value gaps that need to be filled up here, and you're about to break into your low volume gap on your volume, right? Not fair value gaps are here. Volume gaps are just a massive hole in volume. Don't want to get those confused, but if you're about to crack into a low volume gap and you have another fair value gap up here at your next high volume node, it would be likely, right? Like, well, hey, if we break this high volume node, I know we could shoot back up to this high volume node. There's some gaps up there. I have a bullish divergence. Hey, I think we're going to go up and fill that gap. It's just something you can use to help you determine, right? It can help you determine the highest probability trade. It's not about always being right or winning every single trade. It's about adding tools to your trading tool belt so you can add a list of confluence to give you the most confidence and give you the highest probability trades. So as I let price kind of play out here, you can see we now have a bunch of red fair value gaps above us. And you can see also, you know, these gaps are being created and filled constantly. And right now, a very interesting thing, this video is currently being recorded on November 29, 2022. And right now, a really, really interesting gap that I am looking at is going to be this gap right here at about $17,080. And we also have a gap to the downside here at about $15,920. So you might be thinking like, am I supposed to be targeting this gap or this gap, right? Should I expect price to come up here or should I expect price to come down here before it goes up here? And the answer to that question is you want to use confluence, right? If I got a very bullish signal down here and I was already looking to go long, it may make sense for me to be like, hey, you know, we do have a fair value gap up here. We might be on our way to go take out that gap. And then you could use that with things such as volume gaps to add more and more confluence. But the basic thing here is you don't want to trade just based off of these gaps. You want to use them and add them into your strategy as a confirmation method. But now you guys know how to use the gaps, how to identify them with or without this paid indicator, and how you can use it to your advantage to, again, get you into the sauciest, most profitable, high probability trades. So guys, I think that's all the time I got for this video. I hope you guys learned something. Now go hit the charts, mark out some fair value gaps. If you don't have Lux Algo Premium, go mark out those fair value gaps manually and go see how price actually interacted with them. Are they getting filled? Are they not? And just get an idea of how these gaps actually work with price action. And if you guys want to sign up for Lux Algo Premium and you want to try out this indicator, they do offer a 30-day money-back guarantee, so you could try it out for 30 days. If you don't like it, you could go ahead and return it for a full refund, and you can save 25% if you use our referral link in the description down below. And I actually think for the next couple of days, they will still have a Black Friday deal going on, so definitely go check that out and stack up those discounts. And with all that being said, that's all the time I got for this video. I'll see you in the next one. Frankie Candles out.